All right, with that, I just want to take the next 20 minutes or so and just walk through some thoughts around investing and investing during times of inflation. Based on the news stories that are out there, I think this is a very topical subject and on the line of the minds of a lot of people. And the end result or the conclusion or some of the slides, and as we go through it, might not be extraordinary or surprising to a lot of people, especially this crowd. But I thought it's timely to go through this topic here and just touch on aspects of inflation and where we are with money supply and money growth. And obviously, with inflation and money supply and money growth, talk about the cause and effect and the resultant case for hard assets and this movement to hard assets that we actually have been witnessing for quite some time again. And then just some concluding remarks around these topics. So away we go on inflation. Where we are right now, I put this title slide together, really since 2002, we've had this battle going on between, two broad parts of the market, inflation versus deflation. And then as you have the broader market and an efficient market, obviously there's a lot of aspects around that. Some people who have been talking about hyperinflation and the possibility of hyperinflation. But the broader battle that's been going on between the market and, let's call it, the people is versus the Fed and other governments is really this battle of inflation versus deflation. And this has really been going on since 2002 and the dot-com bubble, and the amount of stimulus that we've been witnessing every time there's a pullback in the market, new programs come in. And some would say this has really been going on since the early 70s and Bretton Woods and the removal of the gold standard and the introduction of the MBS market and the slow monetization of debt that we've seen. But it's definitely heated up since 2008 and the global financial crisis, and even more recently with COVID and the stimulus plans that we've been seeing coming out of COVID. So where are we here on the tail of the tape right now? And on the one side, you have the people or the market or the population here, and we're faced with rising prices and rising prices every day, even though the Fed says X food and energy, or if we substitute ground beef for steak, or if we change the way we calculate inflation, there is no inflation that's out there, but people are seeing increased prices every day, whether it's, gas or food, or whether it's auto insurance or home home prices, or, general cost of goods with semiconductor shortages, aluminum and steel tariffs and other duties. We're seeing higher input prices coming through the system. Many companies now are discussing how, these higher input prices are causing them to push through cost price increases. We continue to see increases in minimum wage and requests for increases in minimum wage and strikes over the past several years for push for increase in wages against general low levels of unemployment. Although shadow stats, if some of you follow shadow stats on that website, some people would argue that we still have a general high level of unemployment and that we're in a period potentially of stagflation, where we really don't have any growth other than that created by government stimulus, and we have relatively high unemployment. But what we are seeing, with the COVID subsidies as well, is a lot of money in the system, and a lot of people you would take their time or vacation and vacation money have been spending on goods and spending on new homes and spending on new cars. And if you're so inclined, some people spending on motorhomes and snowmobiles and motorcycles and all these, Sea-Doos and all of these things that has a very tight supply chain right now, and continue to see price increases. Against all of that, this tail of the tape is the Fed and other governments, and this belief or view that all of this that we're seeing is transitory. And Jerome Powell was out the other day and he's adamant that these higher consumer prices are transitory, and the bank's going to maintain their $120 billion a month bond buying program. And we're likely not going to see any rate increase until 2024. So this bond purchase program and the printing press and funding the deficits in the US and the 80 billion a month out of the EU, and these government stimulus programs continue. I think the main aspect here and the differential that we're starting to see probably towards the start of this year is really this new perception now. And the key here is that inflation is largely driven by perception and the beliefs by individuals or consumers that higher prices are here to stay. And anecdotally, it seems like this is where we are in the cycle, that there is this belief that higher prices are here to stay. Prices are sticky down, as they say. And once you have higher fuel, higher food, higher insurance, a push for higher wages, higher general input prices, increased home prices again, that all of these levels of inflation are here to stay and to stick around. Just some aspects of inflation here, just some quotes you can read in your own time if this presentation circulated later. Quite simply, Milton Friedman, I guess, summarized it best and reiterated this view that inflation always and everywhere is a monetary phenomenon. And this is something that the Fed and other governments have been on. If you print enough money and you force it into the system and you expand the monetary base, eventually velocity will slowly start to pick up and you'll cheapen this fiat currency versus all hard assets and real things. And we will get spending again. And, this aspect that, targeting inflation is the polite way of government saying that we're going to slowly erode your savings. So you're better off to spend now than to save. So let's just take a quick look at some of the root causes here of money growth and the aspects behind this. And really, this is, this unprecedented growth in debt overall. And that's why some say that this experience come back to the 1970s when we introduced the MBS market and started to monetize debt and got off Bretton Woods. And we continue to expand money supply, and deficits grow larger and larger, and through this myriad of stimulus programs enacted by governments globally. And this is just a picture of gross domestic product debt held by the public in the US as an example. This slide, I know you can't read this and it's irrelevant actually, but what it is, it's irrelevant the fact that you can't read it, but what it is, it just shows that after the trillions of US dollars created and spent for items that we can't even recall, from 2000 and then the GFC in 2008, people who have been in the market and are students of the market and have been following this TARP, TALF, QE 1, 2, 3, QE infinitum, cash for clunkers, new home buyers plan, consumer products plan, all the bailouts of GM, Ford, the banks, etc. The developed world in the first 3 months of the COVID stimulus program, what this number shows is really this developed Western world injected $4 trillion into the global marketplace, or 6% of global GDP. The US has now added another 4 trillion since that time. And many of you are probably aware, Biden wants to spend another $4 trillion in his greening of the economy and his so-called new stimulus program that Janet Yellen says he should push forward with. And even if it triggers inflation and interest rates persist into next year at a higher level. And where that puts us, obviously, is this ever-expanding Fed balance sheet now sitting at $8 trillion of money that's been created and continues to grow. And it's really this monetization of and funding the U.S.'s own deficits and all of these stimulus programs that continues to increase, money supply. And what we're witnessing really is, the markets and hard assets and all goods really inflating. As you cheapen this currency, it now costs more dollars to buy what the same dollar used to buy in the past. What we're also witnessing is, a global yield carry trade as a result. Money is free, negative real interest rates, and you're being paid to borrow, and the banks are being paid to borrow and fictitiously rebuild Tier 1 capital ratios by taking negative real rates and investing in any yield product they can find to rebuild Tier 1 capital. And as a result, we've seen this compression in yield across the spectrum. Junk bonds that used to be 12, 13, 15% are now, 3.5, 3.7% is considered a junk bond. Velocity has consistently started to grow as lending has come back since 2010. And we're witnessing this in the housing market again and in new cars. And as I touched on earlier, our COVID checks and other stimulus programs going into motorcycles and snowmobiles and boats and all of these items that if you're lucky enough or want to buy one of them, they're very difficult to get right now. A very tight supply chain. And a lot of this yield carry trade has gone into margin loans and into the stock market. And so the cause and effect of all of this is really get me off of this cheapening fiat currency, which you continue to print and inject into the system, and buy me stuff. And what has that resulted in the past? In the extremes, this is hyperinflation of Weimar Republic Germany. Buy me stuff. If you lose your productive capacity, if you have your steel mills and manufacturing facilities and your railroads and all your ability to produce and have productive capacity for GDP, the only thing you're left with is printing. And people would rather own stocks and hard assets and art and collectibles than own currency. And we saw an extreme move in the valuation of the stock market as a result. Another result people might remember is Zimbabwe. Same thing. If the economy is broken and you lose your productive capacity and you take away all of the farmland and these farms close and you destroy the breadbasket of Africa and you lose your GDP and you have no productive capacity, the last thing you're left with is money printing. And people would rather be in, what was the world's best performing stock exchange at the time, buying companies and getting off of Zimbabwe dollars at the time. Venezuela is another recent example. Obviously, as you tax and nationalize your oil industry and you have this decline in productive capacity and you go into this extreme level of hyperinflation, and as a result, people want off the local currency and will buy, once again, try to get money out of the country, buy collectible goods, art, gold, and the stock market inflates as a result. Now, I'm not saying the US or Canada or other developed nations go into hyperinflation because these are the extremes, and I can't really see a rational process for the US losing its productive capacity, given its status in the world. So I don't see hyperinflation as an end result for the US market, but this is what can happen in the extremes. But it does explain a bit of the stock market and where we are and why valuations can get stretched in the global markets, because the markets are acting a bit of an inflation hedge of that yield carry trade. If money is free or cash is trash, and the first rule of finance is that money is supposed to flow to where it can earn its best economic return. But if money is free and endless and capital is not scarce and yields compress, and in fact you have negative real rates and you're being paid to borrow, then you can pay up for goods and multiples will expand under the scenario when this first rule of finance is broken. So we're at this point now. If you use the Shiller PE, the U.S. market is close to that dot-com high, 37.5 times multiple. It was 47 or so during the dot-com bubble. If you look at 12-month trailing earnings right now, the U.S. is at that .com level of around 30 times on trailing 12-month. Now, I'm not saying the U.S. market is poised for a big pullback and a collapse anytime soon. Timing is a bit of a mug's game, and based on Powell's comments, as I touched on earlier, we're probably at least potentially 2 years away from any major correction in the market. He's got his gas pedal to the floor. He's doing 120 billion a month. That doesn't seem to be ending anytime soon. Biden is pushing ahead with a $4 trillion stimulus plan and greening of the economy in the U.S. under that premise, and rates don't seem to be going anywhere until 2024. So money continues to be available and cheap. So, this market could probably continue for another few years, and trying to time that market and what the black swan event is going to be to set it off is very difficult. So I would expect this market to continue to act as an inflation hedge and continue to go higher. Obviously we've seen some volatility in the short term. More recently, as rates creep up a little bit, expectations of inflation have been creeping up a little bit. So then you have this concern over the value of the dollar in the future and what that dollar is worth in the future. And that becomes a little bit more uncertain. And in those scenarios, 60%, 70% of the market is being driven by margin loans. So you get people who want to take some profits, repay a little bit of those margin loans, lock in those gains, multiples compress a little bit, and volatility increases. But right now, the Fed, the ECB, Japan continues to keep the gas pedal to the floor. So where does that leave us? Obviously, in the case for hard assets is diversification only continues to be positive for hard assets and other goods as a store of value. I'm not going to really go through this gold supply and demand. I think people can, this is another slide people can read on their own. All I will say is that everybody's witnessing this, the increase in physical bullion, the demand for hard assets and other commodities as portfolio insurance, diversifying global portfolios. There's many articles out there of large institutions and Ray Dalio and others, owning 5% or more of physical gold or hard assets or other commodities. And now we're seeing this start to rotate even more so into the commodity equities once again. Another positive for the hard assets, which might drive things further, is Chinese stimulus might come to the rescue again. We hope. China continues to build on internal infrastructure and their alternative energy grid and that whole platform. This might lead to a further turn in the hard assets underpinning hard assets and copper and other types of commodities. What we are seeing is they continue to plow forward with this Belt and Road Initiative, which should be, result in a lot of strong demand for the broader commodity suite going further in this pull on commodities. U.S. infrastructure, we touched on briefly before. Biden's plowing ahead with his $4 billion, greening economy. So that continues to plow ahead. So we skip through those slides. So quick summary and in conclusion here, obviously this ongoing monetization of debt, stimulus programs, the tight supply chain that we're seeing, the fact that prices are sticky down, we're starting to see some inflation in the system here. This is obviously positive for natural resources stocks. Real estate, residential and commercial, undeveloped industrial land, farmland, all these things continue to remain strong. All of this monetization and these bailout programs have flowed into all hard assets, scarce hard assets, art and collectibles, automobiles, rare and unique watches, these types of things. And we're seeing a big pickup in the physical commodities now in that diversification aspect of the portfolio, and portfolio insurance starting to be included more in multi-asset portfolios. You used to say, 5% of your overall portfolio should be in natural resources and hard assets, 5 to 15%, depending on your risk profile. And if you went over 15%, if you were lucky enough that, and smart enough that your stocks and your commodities have really performed and you're well above 15%, that you should probably reallocate and redistribute that and take that down a little bit. But that is definitely an area that talking to a lot of other institutions and multi-asset portfolio managers, that they're looking to increase this level of diversification in hard assets. And with that, I'd just like to say thank you for the time and for taking the time at the end of the day to listen to my quick little presentation.